Why is Mississippi the way it is? There's no delicate way to put this. Mississippi has the worst state economy in the entire USA. What factors have led to this dire situation and what can be done to change it? Let's delve into the history, challenges, and potential solutions for turning Mississippi's economy around. Let's break it down. Mississippi holds the unfortunate title of having the lowest GDP per capita among all the states. Its labor force participation rates are among the lowest, meaning fewer people are working or looking for work. This state also has the highest poverty rate and one of the slowest growth rates in the world's largest economy. These aren't just numbers on a page, they translate into very real quality of life problems for the people living there. For instance, Mississippi has one of the lowest life expectancies and overall human development levels in the country. The average person from Mississippi lives 5 years less and earns almost half as much as the average US citizen. That's a stark contrast. In any large group, like the states that make up the USA, there are bound to be some that rank well and others that rank poorly. But what's particularly intriguing about Mississippi's economic struggles is that this state used to be the richest in the nation. Yes, you heard that right. At one point, Mississippi was at the top. Imagine Luxembourg trading places with Moldova in the European Union. That's the level of shift we're talking about here. This decline didn't happen overnight. It's been a slow process over the past century. And that makes Mississippi a fascinating economic case study. What went wrong? Why did this state go from first to last? To understand this, we need to unpack the root causes of Mississippi's decline. This isn't just a history lesson. It's a story that offers insights into the challenges of operating within a larger economy where almost every other state can offer its citizens better opportunities, better living standards, and better support systems. Consider the broader context. Every other state in the US offers more in terms of economic opportunities, quality of life, and social support. When you're competing in such an environment, how does a state like Mississippi turn things around? Is it even possible? Or is Mississippi destined to remain an economic underperformer in a country full of overachievers? One reason for Mississippi's decline is its reliance on agriculture, particularly cotton, in its early economic history. While this made Mississippi wealthy in the 19th century, the lack of diversification hurt the state as the economy evolved and industrialized. Other states adapted and diversified their economies, while Mississippi lagged behind. Education is another critical factor. Mississippi has historically had lower investment in education compared to other states. This has long-term effects, as a less educated workforce is less adaptable to the changing demands of the modern economy. States that prioritize education typically see better economic outcomes, and Mississippi's underinvestment here has certainly played a role in its economic struggles. Infrastructure is yet another piece of the puzzle. Poor infrastructure makes it difficult to attract and retain businesses, which in turn hampers economic growth. When you compare Mississippi's infrastructure to more economically successful states, the differences are stark. Additionally, social and economic policies have had their impact. Policies that don't support business development or adequately address social issues can create an environment where growth is stifled. Back in the early days of the USA, Mississippi was riding high on the hog, thanks primarily to its booming agriculture sector. This agricultural success translated into substantial wealth, making Mississippi the wealthiest state in the Union for quite some time. But how did Mississippi go from being the richest to the poorest state? The story of Mississippi's decline is a classic example of the pitfalls of economic over-reliance on a single industry. As other states industrialized and diversified their economies, Mississippi lagged behind, sticking primarily to agriculture. The Civil War and its aftermath devastated Mississippi's economy. The abolition of slavery meant the loss of the labor system that had underpinned the state's wealth. The transition was tumultuous and left Mississippi economically crippled for years. Economic growth relies on good infrastructure, and Mississippi has consistently lagged in this area. Poor roads, limited public transport, and inadequate utilities make it difficult to attract and retain businesses. Social and economic policies that didn't support business development and failed to adequately address social issues have further stifled growth. Other states have created more business-friendly environments and better social safety nets, putting Mississippi at a disadvantage. Is there a way for Mississippi to turn things around and regain relevance in the modern economic landscape? Some experts believe it's possible, but it won't be easy. Prioritizing education can create a more skilled workforce, attracting businesses that need talented employees. This means higher incomes and better job opportunities for residents. Upgrading infrastructure would make the state more attractive to businesses and improve the quality of life for its residents. Better roads, utilities, and internet access are crucial. Moving beyond agriculture and attracting industries like technology, manufacturing, and services could provide a more stable economic base. Diversification is key to resilience. Implementing policies that support business development, innovation, and entrepreneurship can create a more dynamic economy. This includes tax incentives, grants, and support for startups. As we've seen globally, investments in technology can massively improve productivity and living standards without necessarily increasing costs. This is where Mississippi could take a page from more successful states and nations. Mississippi's early economic history was dominated by plantations that exploited enslaved labor, resulting in minimal labor costs and maximum utilization of the region's fertile land. This combination allowed the state to thrive on its cash crops, which were in high demand globally. In economic terms, the production of any good relies on three key components: land, labor, and capital. Mississippi's effective use of free labor and fertile land reduced the necessity for capital investments, such as roads, machinery, factories, and tools. Interestingly, in that era, enslaved people were treated almost like capital rather than labor. They were considered investments to boost the productivity of plantations, much like machinery would in other industries. Wealthy plantation owners, therefore, had little incentive to invest in modern capital assets, such as automated farm equipment, when they could simply purchase more enslaved people and provide them with basic tools. Moreover, Mississippi's geography, characterized by the extensive waterways of the Mississippi Delta, diminished the need for infrastructure development like roads. The ease of transporting goods via these waterways meant that almost all industries were situated along the rivers. Consequently, the areas between these rivers remained sparsely populated well into the 20th century. Even after the Civil War, Mississippi's economic policies remained heavily skewed towards traditional agriculture, despite the burgeoning potential of the mechanical industry that was revolutionizing other economies. The state had the resources to excel in emerging industries, a sizable labor force, access to ocean trade routes, and potential links to European markets. Policymakers and potential industrialists of the time were averse to the idea of black people working in factories, further stalling industrialization. Thus, the very factors that had contributed to Mississippi's economic strength in the early 19th century became its impediments by the century's end. The reliance on slave labor had created a wealthy, isolated class of landowners who saw little benefit in investing in industrial infrastructure or diversifying the economy. In 1865, 55% of Mississippi's population were former slaves. Although they were no longer enslaved, their new reality was fraught with difficulties. They were now responsible for their own livelihoods without any support or resources. The state was left with a population that was largely uneducated and deeply divided, with few opportunities for advancement. The new state constitution, which favored agricultural interests, only compounded these issues, preventing the state from leveraging its potential in other sectors and leaving it economically stagnant. The recorded wealth of Mississippi saw a dramatic collapse post-Civil War, not just due to the loss of its primary industry, but also because of a significant shift in how assets were counted. Frequent flooding, tropical diseases, tornadoes, and poor soil quality hindered collective progress. Even today, these environmental issues make doing business in Mississippi more challenging than in many other parts of the USA. Imagine trying to build wealth with the constant threat of natural disasters. If one person can keep their home and investments intact, while another's assets are repeatedly destroyed, the former will naturally accumulate more wealth over time. This analogy scales up to the state level, highlighting the persistent economic predicament Mississippi faces. In summary, Mississippi's historical reliance on agriculture and slave labor created a narrow, fragile economic base. The loss of slave labor, combined with environmental challenges and resistance to industrialization, left the state struggling to adapt to the changing economic landscape. This legacy of limited capital investment, environmental adversity, and social division continues to influence Mississippi's economic trajectory. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section. Are you riding the Bitcoin wave or risking being left behind? The investment world is full of people betting on Bitcoin, excited about its potential. And who wouldn't be? No one wants to be on the wrong side of a financial tidal wave, struggling to keep up. Yet, let's take a step back and consider a scenario painted by Warren Buffett, a man whose financial acumen speaks volumes. Imagine, he suggests, if the entirety of this room owned all the farmland in the United States. And then, with a mere offer of a 1% stake for $25 billion, he'd be writing a check faster than you can blink. Why? Because farmland yields tangible returns, producing food to nourish and sustain. Let's shift the focus to apartment buildings. Again, a 1% stake in all the apartment houses in the country, offered at a similar price, would be an irresistible proposition. Rental income flows steadily, ensuring a return on investment that stands the test of time. But what about Bitcoin? There's the rub. Buffett's skepticism shines through as he contemplates owning all the Bitcoin in the world for a meager $25. It's a pass from him, and with good reason. Bitcoin, unlike farmland or apartments, holds no intrinsic value. It's a digital entity, devoid of the ability to produce anything of substance. If they were to hold all the Bitcoin in the world, it would undoubtedly raise eyebrows. Everyone knows where they stand, and if they were to start offloading Bitcoin, the questions would come flooding in. Why should we buy Bitcoin from you? People would ask. Why not create your own currency? Call it Buffett coin or something. And you know what? They'd have a point. After all, why pay a premium for something that lacks inherent value? That's where the distinction between productive assets and speculative investments becomes glaringly evident. Productive assets, like farmland and apartment buildings, offer tangible returns. They produce food, they generate rental income, they contribute to society. But Bitcoin? It's a different story. Its value hinges on the whims of the market, on the hope that the next person will pay more than the last. It's a game of hot potato, with commissions and frictional costs lining the pockets of those who facilitate the trade. Investing in assets that create real value, that contribute to the economy, that's where the true wealth lies. As for Bitcoin, well, it's a speculative gamble, one that may pay off for some, but holds little appeal for those grounded in reality. But consider this. When one group of the public takes money out or a new group of owners enters the scene, it's not like new money magically materializes. It's simply a reshuffling of funds, a game of musical chairs where the music never stops. Sure, there's movement, transactions, and the illusion of wealth changing hands, but in reality, the room holds no more money than it did before. It's a shell game, fraught with the risk of fraud, hidden costs, and all sorts of uncertainties. And let's not forget, this phenomenon isn't new. Throughout history, certain assets have been imbued with value despite their lack of tangible productivity. Take, for instance, a masterpiece painting. While it may not churn out goods or services, its cultural and historical significance can endure for centuries. Even if you were offered a pyramid for sale, with the promise of attracting viewers and standing the test of time, it still wouldn't produce anything tangible. Absolutely, there's no denying the allure of attractions like the pyramids. They hold a certain mystique that draws people in, much like a captivating parade. However, when it comes down to it, assets need to deliver something tangible to someone in order to hold real value. And let's talk about currency. Sure, we could dream up Berkshire coins or Berkshire money, but that's a slippery slope. At the end of the day, the only universally accepted currency is the United States dollar. With nearly 2.3 trillion of these bills in circulation, it's clear that people trust in the stability of the US government's currency. So, while Berkshire coins might sound appealing, the reality is that they could never replace the almighty dollar. Anyone who thinks otherwise is simply out of touch with reality. So, despite any potential shortcomings, it's clear that when it comes to currency, the greenback reigns supreme. Whether Bitcoin's value skyrockets or plummets in the next year, 5 years, or even a decade remains uncertain. But one thing is crystal clear. Bitcoin doesn't multiply, it doesn't produce anything tangible. Just look at the gold rush on Wall Street, where the allure of riches blinded many to the inherent risks. And in recent years, the stock market has taken on an almost mythical quality, teetering between casino-like speculation and genuine investment. When Warren Buffett speaks of Wall Street, he's referring to more than just a trading floor. It's a symbol of the entire capital formation market, where dreams are made and fortunes are lost. And in recent times, the market's performance has been nothing short of extraordinary. The dynamics of capital markets are a curious blend of investment wisdom and high-stakes gambling. At times, they operate as the bastions of sound investment principles, as you'd find in textbooks or learn about in classrooms. Yet, there are moments when they transform into virtual casinos, where the thrill of the game overshadows prudent investment strategies. In recent years, this transformation has been particularly pronounced, fueled by a culture that glorifies quick gains and speculative trading. Wall Street, once revered for its role in fostering long-term growth, has become a playground for day traders and speculators. Sure, you might hear tales of those who bought into Berkshire Hathaway in the 60s and held onto it for decades, reaping massive returns. But let's not forget the brokers left in their wake, struggling to make ends meet as their clients held steady. The truth is, Wall Street thrives on volatility. It's far more lucrative to cater to the whims of the thrill seekers, those who treat stock trading like a game of chance. After all, uncertainty breeds opportunity, and nowhere is this more evident than in the stock market. So, as the opening bell rings each morning, one thing is certain: nobody has the faintest idea what the day holds. On Mondays, Warren Buffett and Charlie Munger never base their decisions on market predictions or economic forecasts. In fact, throughout their storied partnership, they've never made a buy or sell decision with the market's fluctuations in mind. Instead, their investment philosophy transcends market noise, focusing on intrinsic value and long-term prospects. It's a testament to their discipline and steadfastness in the face of uncertainty. While others may credit Buffett for his optimism during challenging times like the 2008 financial crisis, he humbly acknowledges that such decisions are rooted in a deeper understanding of value, not blind optimism. This approach speaks volumes about the nature of learning and decision-making in the investment world. It's not about chasing trends or reacting to headlines. It's about cultivating a deep understanding of companies and industries and making informed judgments based on fundamental principles. So, while the world may marvel at Buffett's seemingly prescient moves, the truth is far simpler. Success in investing lies not in predicting the future, but in understanding the present and staying true to timeless principles. During times of market turmoil, Warren Buffett and his team at Berkshire Hathaway made a significant investment decision, a move that would later be deemed ill-timed. Around the period between investing in Wrigley, Goldman Sachs, and General Electric, they committed a substantial portion of their net worth, totaling around $15 to $16 billion. While this sum may seem relatively small compared to Berkshire's current scale, it was a considerable commitment at the time. In hindsight, Buffett acknowledges that this investment spree occurred during a less than ideal market climate. He's quick to point out that he didn't possess a crystal ball to foresee whether it was a wise or foolish move. Nevertheless, the timing proved to be less than favorable. Warren Buffett candidly admits that when it comes to timing the market, he's far from infallible. Reflecting on his investment decisions during the tumultuous period of 2020, he acknowledges missing out on what could have been an even more opportune moment to invest. In March of 2020, when the market hit its lows, Buffett's timing was off. But here's the thing, timing the market has never been Buffett's forte. Instead, Buffett emphasizes a simple yet powerful principle. Focus on the value you're getting for your money. Whether it's buying stocks or entire companies, Buffett and his team are adept at assessing when they're getting a good deal. And here's the kicker. They're not looking to time the market perfectly. Instead, they hope that after they've made their purchases, the companies they've invested in will continue to thrive, increasing their value over time. It's a strategy so straightforward that Buffett quips you could learn it in 4th grade. And yet, its simplicity belies its effectiveness. By eschewing market timing in favor of focusing on fundamental value, Buffett has built one of the most successful investment track records in history. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comment section. Imagine knowing the secrets of a man who predicted the 2008 financial crisis and turned it into a fortune. Michael Burry, the legendary investor immortalized in The Big Short, is back with bold new moves in the stock market. What could he possibly be seeing that others don't? Brace yourself as we dive into his latest 13F filing to uncover the secrets of his portfolio and what it might mean for the rest of us. First off, for those of you who might be new here or need a quick refresher, Michael Burry is the genius who predicted the 2008 housing crash. His story was so captivating, it became a movie called The Big Short. Now, Burry is known for his sharp, often contrarian investment strategies. And when he makes a move, the financial world pays attention. Burry just released his latest 13F filing. This document is like a peek behind the curtain, showing us what stocks he's buying and selling. Usually, Burry's moves can seem all over the place from one quarter to the next, making it tricky to pin down a clear strategy. But this time, 2 strong themes have emerged, giving us a bit more to chew on. Inflation. Remember when we thought we were getting inflation under control? Well, Burry seems to think otherwise. He's betting big on another wave of inflation hitting us in 2024. Why? Burry believes that the economic measures taken to curb the initial wave of inflation might not be enough, and we could be in for a second round. And if history has taught us anything, it's that when Burry makes a prediction, it's wise to listen. Now, digging into the specifics, Burry's portfolio shows some interesting shifts. He's heavily investing in commodities and companies that tend to perform well during inflationary periods. Think of sectors like energy, agriculture, and basic materials. These are the industries that can pass on higher costs to consumers, making them a safer bet when prices are rising across the board. One standout move is Burry's increased stake in oil and gas companies. With the global energy landscape being as volatile as it is, and with supply chain issues still making headlines, this move suggests he's anticipating higher energy prices. And higher energy prices often signal broader inflationary trends. But that's not all. Burry is also eyeing agricultural stocks. Why? Because food prices are a major component of inflation. As the world grapples with climate change and supply chain disruptions, agricultural commodities are likely to see price hikes. Burry's bet here is that these stocks will benefit as food costs soar. Now, let's address the elephant in the room. Is Burry's prediction something we should all be worried about? Well, he's been right before, and his track record speaks volumes. But it's also important to note that the market is unpredictable. While Burry is positioning himself for what he sees as an inevitable second wave of inflation, we need to consider other factors too, like potential government interventions and global economic shifts. So, what does this mean for the average investor? Should we all start buying up commodities and energy stocks? Not necessarily. While it's intriguing to follow Burry's moves, it's crucial to do your own research and understand your own risk tolerance. Diversification is key, and jumping on trends without a solid plan can be risky. Now onto the specifics of his recent activity. Burry has been doing a lot of chopping and changing in his portfolio. He sold out of 14 stocks, including big names like Google, Amazon, and Oracle. At the same time, he added to 11 positions and bought 5 new stocks entirely. Here's where it gets really interesting. One of these new additions is the Sprott Physical Gold Trust. In Q1, Burry bought over 440,000 shares, making up 7.37% of his US portfolio. Now, you might wonder why he's buying into gold when prices are already high. Well, gold is a classic hedge against economic uncertainty and inflation, two things Burry is very concerned about. Sprott Physical Gold Trust is a closed-end fund that holds assets in physical gold bullion. With gold prices at near all-time highs, this move might seem odd for a value-minded investor like Burry. However, gold is a safe haven during times of economic instability and market volatility, something Burry has been vocal about. His investment in Sprott aligns perfectly with his long-standing concerns about economic conditions. Now, historically, gold has been a go-to asset during economic uncertainty. Its price spiked during the Great Depression, skyrocketed in the 70s, for reasons we'll discuss shortly, and surged after the tech bubble burst, the 2008 financial crisis, and more recently during the COVID-19 pandemic. While much of gold's appeal is psychologically driven, the trend is undeniable, and Burry is banking on this uptrend continuing since October last year. With all that's happening globally, from tariffs and elections to wars, supply chain disruptions, and rising inflation, gold is an attractive hedge. Beyond economic downturns, investors flock to gold for its stability. It's a similar story to why Burry is increasing his positions in commodities and agricultural stocks. In summary, Michael Burry is back and making bold predictions once again. His latest 13A filing reveals a clear strategy aimed at preparing for a second wave of inflation in 2024. By investing heavily in commodities and industries that thrive in inflationary times, Burry is positioning himself to potentially profit from what he sees as an inevitable economic shift. Michael Burry has a significant investment in JD.com, which is the largest stock in his US portfolio. This investment is worth approximately $99,986 million. However, considering his estimated total fund size of $238 million, JD.com represents just about 4% of his overall portfolio. While this is a substantial investment, it is not overwhelming in the context of his entire fund. More interestingly, Burry appears to take a cautious approach to investing. It is estimated that around 52% of his portfolio is allocated to US Treasuries. This large allocation suggests that Burry is being careful amid the current market volatility, preferring the relative safety of government bonds over more volatile equities. It's important to understand that the information about Burry's investments comes from 13F filings. These filings provide a snapshot of his US portfolio at a specific point in time, but they have limitations. For one, they only cover his investments in the United States, meaning any international investments he holds are not included. Therefore, the 13F filings do not give a complete picture of Burry's entire investment strategy. In addition to the limitations of the 13F filings, these documents only show what Burry held at the end of the reporting period. They do not account for any changes made shortly before or after the filing. Given these factors, it's essential to consider the broader context when analyzing Burry's investments. His significant holding in JD.com and the substantial allocation to US Treasuries indicate a balanced strategy. On one hand, he is investing in a major Chinese company, reflecting confidence in its growth potential. On the other hand, his large investment in US Treasuries shows a preference for stability and caution, likely as a hedge against market uncertainty. Thanks for watching. Please like the video, press the subscribe button, and also drop your thoughts in the comments section.